webinar for the Originations Overview of the FHA changes to the 4000.1 HUD Handbook. This presentation is hosted by HomePoint Financial in collaboration with Indicom Mortgage U. Effective for case numbers ordered on or after September 14, 2015, the FHA 4000.1 HUD Handbook will be used for guidelines for single-family FHA transactions. This new handbook replaces the 4155.1 and 4155.2 Housing Handbook and it consolidated past mortgagee letters. Now you have one concise location for your FHA rules and regulations. However, FHA also made significant guideline changes in the new 4000.1 handbook without issuing new mortgagee letters to announce the changes. We've been diving into the new handbook to compare it with the old 4155.1 and 4155.2 handbooks, and today's webinar will point out those differences we have discovered. The agenda for today, we will go over the overall impact of the changes to originations. Also, we'll compare the FHA guide, the new 4000.1 guide that is, to your HomePoint policy, which is available for you on your product matrices on your TPO portal. We'll review specific guideline changes related to qualifying and underwriting, and we'll also go through specific changes related to appraisals and the process. This really is a big deal for this change to the new 4000.1 handbook. As I mentioned before, FHA will be retiring the long-standing 4155.1 and 4155.2 handbooks and consolidating information into the new handbook. This also includes mortgagee letters. So if you're new to FHA, you have an advantage here. For those of us that have been working with FHA loans for a long period of time, it's very easy to quickly go to the 4155.1 handbook and find what you're looking for. And now with the new 4000.1, we really are all at the starting line, learning how it's organized, where the new guidelines call, and what documentation requirements call for, learning the nuances of FHA underwriting. The downside is that, unfortunately, fewer borrowers will qualify because there are some very strict standards when it comes to credit, income, assets, and appraisals now that we weren't used to in the past. There are fewer areas to layer risks in automated and manual underwriting as well. So we'll go through those details with you. You also should have a training job aid to use in collaboration with this PowerPoint, and I'll be referring to that job aid as we move along through these guideline changes. The upside to the new 4000.1 handbook is that the discussions between sales and operations over income or documentation requirements, those should be reduced. You're going to find that with the new 4000.1 handbook, you'll see some clarity with the instructions stating that certain things must be done or certain documentation must be obtained for the file. Whereas in the past with the 4155 handbooks, they may have used some more less flexible language, or more flexible language, I should say. They may have used the word should, and that created a little bit of gray area between sales and operations. So now you'll be finding that you see the word must in a lot of locations with some very specific documentation or income requirements or even the math that's involved. So we'll go through those with you in today's session. There's also important criteria that was previously understood by an experienced underwriter is now stated in more detail. So for those of you that may be new to the FHA side, it's really going to be a benefit for you to understand how this 4000.1 HUD handbook works, because things are going to be stated for you in very much more detail than what we're used to. The credit overlay picture, just like HomePoint Financial has credit overlays, many companies have their own credit and property underwriting overlays. And since FHA has essentially tightened their underwriting in most cases, there's really no rush to change what FHA has published. You don't really find lenders going to their congressmen saying, change this or pull this back. Everybody's really taking in what the new guidelines call for and appreciating how the verbiage is clearer now and more explicit than what we were used to in the past. But there are still a few areas that still need some clarification, so watch for that to come from the mortgagee letters coming in the future or FHA info emails coming from the Department of Housing and Urban Development. There are some areas, though, where lenders generally won't change, which includes minimum credit score requirements and the DTI combinations. As I mentioned before, always make sure that you're looking at your product matrices on the TPO portal for those details coming from Home Point Financial. Ineligible property types, such as manufactured homes or condos that are not on the FHA approved list, those are the same. So whatever ineligible property types you typically found in the 4155.1 handbook or 4155.2, now you're seeing those same ineligible property types in the 4000.1 handbook. So you really didn't see any changes with that. Whether FHA manual underwriting is permitted. Home Point Financial does allow FHA manual underwriting, so that's a benefit for your borrowers. Occupancy requirements, well, that really hasn't changed either. FHA is still primarily an owner-occupied primary residence type of transaction for your borrowers, so that really hasn't changed either. The philosophy for FHA is still standing firm with that. To give you an idea of how the handbook is organized, you can see that on the screen in front of you. Part 1, which is called Doing Business with FHA, that's really primarily for lenders to follow, getting new hire details, signing up through FHA Connection, and so forth. So that's more of an organizational chapter. But you're going to be focused more on Section 2, which is origination through post-closing and endorsement, where it's going to outline details for documentation requirements, credit, income, assets. Appraisal details are contained in there as well. There's even a section for condo project approvals and so forth. So this is a section that is effective for case numbers ordered on or after 9/14 of 2015. You'll find, based upon the colors and the key that are on this screen, there are some sections that will be getting their approval and being open to the public later this year, but not for the origination through post-closing and endorsement. That is effective 9/14 for case numbers. Let's look at some of the changes impacting the real estate community. The real estate community is still trying to understand how the TILA-RESPA integrated disclosure rule will impact the time it takes to close a loan. We're still working on that and having a lot of meetings to figure out what kind of timeframes are we looking at for a purchase agreement to really be able to close a loan. And looking at FHA changes now adds a little bit more uncertainty. So there's really still a lot of communication that's going on and understanding of how these rules work and how they're going to impact the time it takes to close a loan. Lenders will need to demonstrate what they have done to prepare for the change. Realtors don't want to hear that a borrower won't qualify due to guideline changes after the loan has been in process for 2 weeks. That's why it's crucial to be familiar with when was your case number ordered. If it was ordered on or after 9/14 of 2015, you're going to be following the FHA 4000.1 HUD handbook for rules and regulations. If your case number was ordered prior to 9/14 of 2015, that's where you're using the 4155 handbooks and mortgagee letters. So it's very important to be clear about that, even if your loan has been in process for a few weeks, which guidelines are you supposed to be following? And be prepared to be able to answer these questions. Is everyone trained in your office? It's crucial that anybody that deals with FHA loans is aware of what this handbook is and the guidelines that have changed. We're going to be looking at things that impact the borrower being able to qualify, and you want to be able to understand how documentation is required now because of these new HUD handbook regulations. Is everybody aware of it? Has everybody been trained? Is your loan origination software ready? Think about conditions and drop-downs and disclosures and notifications that are going to the borrower. All of that has to be programmed properly with what the new FHA guidelines call for. Test cases are a perfect way to make sure that that's running properly. How will you handle FHA and TRID changes at the same time? You could very well encounter that where you have an FHA file where the case number was ordered on, let's say, September 17th, for example, but that is still prior to the October 3rd effective date for the integrated disclosure rule. So with that transaction, you're using the new FHA guidelines, but you're still utilizing the RESPA good faith estimate HUD 1 settlement statement requirements. But then you might have other files where the case number was ordered, say, October 10th, and now the application was, let's say, October 10th, And so you have the integrated disclosure rule requirements now. So you have the new FHA changes, and then you have the loan estimate and closing disclosure being involved in the transaction. So it's very important to keep an eye on your pipeline, know your application dates, know your case number dates to make sure you're understanding which guidelines are applicable. Will your loan close on time? Sometimes with the new guidelines, there might be some delays with getting the appropriate documentation because we're all getting used to what the 4,000 guidelines call for. But as you don't forget your document expiration dates as well. Is the house FHA eligible? Well, you're going to find that experienced FHA realtors are often the first eyes on the property to identify if the property might meet FHA requirements. They look at a property and they know that will have to be repaired, that will have to be fixed. The appraiser is going to make a note of that, or there needs to be a water test, or what have you. They too will be back at the starting line with new realtors to understand what the new property repair requirements call for. Everybody has to understand how the appraisal has been impacted by these guidelines as well. Well, the areas that are impacting the borrower, they do run the gamut here. You're starting from credit. Even income has been impacted by these new guidelines, sources of funds documentation, and required repairs. There's every one of those topics have had some type of impact by the 4000.1 new guidelines. So let's review the changes impacting a borrower's ability to qualify. So if you take a look at that job aid, that is, should be nearby with this PowerPoint as you're listening, you're going to want to look at page 1 of the job aid, where we're going to go through these 5 bullet points that you see on screen. The age of documents, military borrowers, multiple FHA loans, the definition of a day, and application name requirements. So let's take a look first at the age of documents. Documents for origination and underwriting may not be more than 120 days old at the time of the disbursement date, which, as you know, is your funding date. So that has been made a little bit different. It's expressed a little bit more clearly now than what we were used to in the 4155 manual, where it stated the documents had to be 120 days old at the time of closing. So that's no longer the rule. Now the rule is documents for origination and underwriting may not be more than 120 days old at the time of the disbursement date. But it also goes on to say that other documents that do not get affected by the passage of time, like a divorce decree or tax returns, those may be more than 120 days old at the time of the disbursement date. So tax returns, divorce decree, you do not have to apply the 120-day rule to those. Military borrowers, as a lender, you must obtain the borrower's intent to occupy the subject property upon discharge from the military service if a family member will not occupy the subject property as their principal residence. Other details still found on page 1 of your job aid. As a lender, you must obtain a copy of the borrower's military orders evidencing the borrower's active duty status and that the duty station is more than 100 miles from the subject property. So you've got a military borrower. So we're not talking about VA loans here. We're talking about an FHA loan, but you have an active duty borrower. You've got some additional legwork that would be needed for the file, additional documentation that was needed. Then you have the definition of a day. Over still on page 1 of your job aid, for purposes of counting days for periods provided in the handbook, a day is counted as the day after the effective date or issue date of the documents, whichever is later. This is more clarification because in the past we've received mortgagee letters that said something like, this is effective 60 days as of this date, or something around those, something similar to those lines. And it was confusing because we weren't sure, do we start counting today? Do we start counting tomorrow to come up with the 60 days? So this definition of day tries to make that a little bit more clearer for us. Then you have the application name requirements. This means that as a lender, you must include a statement to verify the borrower's identity using valid government-issued photo ID prior to the insuring of the mortgage. Or, as a lender, you may choose to include a copy of such photo ID as documentation. So that is over at the top of page 2 of your job aid. So this is different than what we've done in the past. You'll probably see some process changes being needed as a result of this photo ID that's needed. And in the past, FHA really wasn't clear about that, but now it is something that the 4000 guide is calling for. Purchase agreements. You can look On page 2 of your job aid for the details that follow this slide. As a lender, you must ensure that all purchasers listed on the sales contract are borrowers or family members. An addendum or modification may be used to remove or correct any provisions of the sales contract that do not conform to these requirements of non-borrowing spouses permitted on the purchase agreement. So in the past with the 4155.1 handbook, it was silent about a non-purchasing spouse being removed from or not permitted to sign a purchase agreement. So no longer is that the case. Now the 4000 guide makes it clear that all purchasers listed on the sales contract are borrowers or family members. There is one less disclosure that we have to worry about now. It's called the simultaneous review disclosure. The 4000.1 HUD handbook does not mention it whatsoever. This was the simultaneous review disclosure was one that was signed when the underwriter and the underwriter did not review the appraisal and the credit report at the same time. So we don't see that anymore in the new 4000 handbook. Let's take a look at CAVERS. Those are still on page 2 of your job aid. CAVERS stands for Credit Alert Interactive Voice Response System. Well, at least that was the old way we described the word CAVERS. In the new 4000.1 HUD handbook, CAVERS is now defined as Credit Alert Verification Reporting System. Credit Alert Verification Reporting System. So nobody dials up a phone number or dials up the phone to get the CAVERS numbers anymore, so that was why FHA changed what the CAVERS acronym actually stood for. Everything is all online now. But it also went into details about what the CAVERS discloses, and if a debt was identified through CAVERS, there is more responsibility that falls on the lender now. You must contact the creditor agency using the contact number and debt reference number reflected in the borrower's CAVERS report. Verified federal debt makes the borrower ineligible. And we gave you the citation on the screen and in the job aid for more details. So as I mentioned before, lenders have to have more responsibility now as a result of this adverse CAVERS number and contact the creditor agency to verify that debt. There's also a section under CAVERS that talks about delinquent federal non-tax debt. So let me go through the details for you on that. Lenders are prohibited from processing an application for an FHA-insured mortgage if a borrower has delinquent federal non-tax debt, including deficiencies and other debt associated with past FHA-insured mortgages. So if the creditor agency confirms that this delinquent federal non-tax debt is valid and in a delinquent status, your borrower is ineligible for an FHA-insured mortgage until they resolve the debt with the creditor agency. They are not allowed to be denied solely on the basis of CAVERS information that has not been verified. If resolved either by determining that the information in CAVERS is no longer valid, or if they've resolved the delinquent status, then you would be able to move forward. In order for a borrower with verified delinquent federal non-tax debt to become eligible, your borrower has to resolve their federal non-tax debt. That means the creditor agency that's owed the debt can verify the debt has been resolved. And as a lender, you must document from the creditor agency to support the verification and resolution of the debt. So for debt reported through CAVERS, lenders may obtain evidence of resolution by obtaining a clear CAVERS report. If your borrower has a delinquent FHA-insured mortgage, they are ineligible for a new FHA-insured mortgage unless the delinquency is resolved. Take a look at delinquent federal tax debt over on page 3 of your workbook. If your borrower has delinquent federal tax debt, your borrowers are ineligible. Tax liens may remain unpaid if the borrower has entered into a valid repayment agreement with the federal agency owed to make the regular payments on the debt. So delinquent federal tax debt would be a situation where your borrowers did not pay their taxes on time. So they can enter into a valid repayment agreement with the federal agency owed, and they have to make regular payments. Specifically, the borrower has to have made timely payments for at least 3 months of scheduled payments, and they cannot prepay to meet this rule. You also have to include that debt in the DTI, the debt to income ratio. You have to check public records and credit information to verify your borrower is not presently delinquent on any federal debt, and they do not have a tax lien placed against their property for debt owed to the federal government. Always include any documentation from the IRS evidencing the repayment agreement and the verification of the payment. The non-purchasing spouse in a community property state, that's also on page 3 of your job aid. The lender must obtain a credit report for a non-borrowing spouse who resides in a community property state or if the subject property is located in a community property state. The credit report must indicate the non-borrowing spouse's Social Security number was matched with the Social Security Administration, or the lender must provide separate documentation indicating that the Social Security number was matched with the Social Security Administration. This is pretty similar to what you're used to doing for your non-purchasing spouses in community property states, but it really, the new part is having that matching up with the Social Security number and the Social Security Administration. Credit and liabilities. This is just a restatement of that delinquent federal tax debt that we were talking about earlier, where they have to have that 3 months of scheduled payments. You can still find this on page 3 of your job aid. Also watch overlays, or which means refer to your product matrices on your TPO portal. Authorized users, this can be a challenge sometimes with determining whether or not we include that debt into the DTI. This is found on page 3 of your job aid. Accounts for which the borrower is an authorized user must be included in a DTI ratio unless you can document that the primary account holder has made all of their required payments on the account for the previous 12 months. So it's very important that if you see an authorized user account on your borrower's credit report, the credit history must be reviewed and there can be no lates in the last 12 months. If there are less than 3 payments on the account in the previous 12 months, the payment amount must be included in the DTI. Let's talk about deferred liabilities, and then we'll talk about student loans. So over on page 3 of your job aid, if you have a deferred liability, so your borrower is buying a car and they get to wait several months before their first payment is due. If you're trying to determine the monthly payment for the DTI, you have to get a copy of what the actual monthly payment is, perhaps it's on the credit report, or get a copy of the loan payment agreement to determine what your borrower's monthly payment is. If neither are those available to give you a monthly payment for inclusion in your DTI, then you must utilize 5% of the outstanding balance to establish the monthly payment. So for deferred liability, if you can get, if the monthly payment is on the credit report, if not, refer to the loan payment agreement. And if it's not available and it's a deferred installment debt, not student loans, it's regular deferred installment debt, you would use 5% of the outstanding balance. Now, for student loans, that's the last bullet point on screen. For student loans, if the actual monthly payment is 0 or is not available, you must utilize 2% of the outstanding balance to establish the monthly payment. The days of proving that your borrower's student loans were deferred for outside of 12 months in order to exclude it from the DTI, those are no longer, you cannot do that anymore. You have to include a payment for the student loan in your DTI. So you look at the credit report. If the actual monthly payment is 0 or is not available, you must utilize 2% of the outstanding balance to establish the monthly payment. That's also for you, listed for you on your job aid on page 3. Installment loans, a regular installment loan, if you're not getting all this documentation before and now it's important for you to start getting it, because if your credit report does not include a monthly payment, you must use the amount of the monthly payment shown in the loan payment agreement or the loan statement. I mentioned that just a few moments ago. For 30 days paid in full, you can find those details on page 4 of your handout of your job aid. A couple of things to verify here. For those accounts where your borrower pays that account off every month, 30-day accounts, as a lender, you must verify the borrower paid the outstanding balance in full on every 30-day account each month for the past 12 months. 30-day accounts that are paid monthly are not included in the borrower's DTI. Next bullet point, the borrower must use the credit report to document that the borrower has paid the balance on the account monthly for the previous 12 months. So you have to look at that history and make sure that that's been paid on time for the previous 12 months. You use the credit report to document the balance, and here's new information. You must document sufficient funds are available to pay off the balance in excess of the funds and reserves that are required to close. So over and above what your borrower needs to close the transaction, you have to make sure that they have the funds available to keep paying off that 30-day account every month. If the credit report reflects any late payments in the last 12 months, that is where you must utilize 5% of the outstanding balance as your monthly debt to include in your DTI. Charge-offs. Charge-offs are defined as a debt written off by the creditor. Charge-offs do not need to be included in the liabilities for debt for approve or accept. It's basically the same for a manual underwrite. However, in a manual underwrite, you're going to find that there's further analysis of the borrower's credit history. Are they showing a disregard for financial obligations? Can they manage their debt? Are there extenuating circumstances? So if there are charge-offs and there's a manual underwrite that's being done for the transaction, there has to be reasons documented for getting the borrower approved when they have charge-off accounts. The borrowers are going to provide a letter of explanation and give any type of supporting documentation for each charge-off. It has to make sense and be consistent with the other credit information that's in the file. It gets a little bit more complicated when you get to disputed charge-off accounts in manual underwriting or through total scorecard. Things like a disputed medical account or those that arise from identity theft or credit card theft are still exempt. But for other disputed charge-off accounts, it is recommended that you take a look at the 4000.1 handbook because it really goes into detail for what would be needed for the file and what types of requirements would need to be looked at and documented. Alimony and child support, when it comes to liability, you're still collecting your pay stubs from your borrowers, looking at the pay stubs to make sure that they're the most current and you're calculating income to qualify. But we also have to take a look at least 28 days of pay stubs, the most current 28 days, to make sure that the borrower is not subject to any order of garnishment relating to alimony, child support, and maintenance. Because if they are, then you have to go down that road with including that with the liabilities and the DTI and so forth. Excluding debt. Still on page 4 of your job aid. We're talking about installment debts with less than 10 months remaining. Installment debts with less than 10 months remaining may be excluded only if the borrower has a cumulative payment of less than or equal to 5% of the borrower's gross monthly income, and the borrower may not pay the debts down to achieve this percentage. So this is a brand new requirement for FHA compared to what was going on with the 4155.1 HUD handbook, where you may have been able to exclude installment loans for less than 10 months. Not anymore. Going forward with the 4000.1, debts with less than 10 months may be excluded if your borrower has a cumulative payment of less than or equal to 5% of their gross monthly income. And the second part of it is we have to make sure that they didn't pay the debts down to achieve this. Let's go through an example. Let's say you have 6 months left on an installment debt. And let's say that the borrower earns $4,000 per month in gross income. 5% of that $4,000 per month is $240. So your installment debt can only be excluded if the cumulative payment is less than or equal to $240 per month. So if in that case, if your borrower's installment payment was $300 per month, you would have to include it in the DTI because it exceeds that 5% of the gross monthly income calculation. Part-time income, that's over on page 5 of your job aid. You'll like this clarification now, and it even goes into detail about the math that's used if you're trying to use part-time income to qualify your borrower. If you're considering using part-time income, here are the rules. There has to be 2 years of uninterrupted part-time income required. Average the income over the prior 2 years or use a 12-month average of hours at the current pay rate if the lender documents an increase in the pay rate. So a couple key words there. We have to make sure that the part-time income has been 2 years uninterrupted. And then determine the math that's used. Average the income over the prior 2 years, or if you can document and prove that they've received an increase in their pay rate, that may allow you to use the 12-month average. Always have to document that, though. Rental income and non-taxable income. Rental income, this is going to be a clarification if you've got a borrower who's relocating. Rental income may be counted when relocating and the new residence is at least 100 miles from the previous residence. In the past, with the 4155.1 HUD Handbook, we didn't have a number of miles in between the two residences to use as kind of as a gauge. So now we have to see at least 100 miles from the previous residence to use that rental income if they're relocating. If no history of rental income since the last tax filing is evident, the borrower must have a 25% equity. Non-taxable income, for those income sources which are not taxed, like Social Security income, you can gross those up for qualifying, but you have to use the greater of 15% or the actual tax rate. In the past, FHA published that as 25%, but now with the 4000.1 guidelines, you have a 15% or actual tax rate. You can refer to the IRS form for income tables as well. Temporary income reduction, like maternity leave, you can refer to page 5 of your handbook for this. For borrowers with a temporary reduction of income due to short-term disability or similar temporary leave, the lender may consider the borrower's current income if you can verify and document that the borrower intends to return to work, the borrower has the right to return to work, and the borrower qualifies for the mortgage, taking into account any reduction due to circumstances. We have some more details in the job aid for you for other situations with this temporary income reduction. Think about those cases for borrowers returning to work before or at the time of the first payment due date. So their borrower's first payment due date is December 1st. They're returning to work November 15th. If that's the case, they're returning to work before or at the time of the first payment due date, you may use the borrower's pre-leave income. For borrowers returning to work after the first payment due date, you may use the borrower's current income plus available surplus liquid asset reserves, those that are above and beyond what's needed for closing, as an income supplement up to the amount of the borrower's pre-leave income. So you do a calculation, which is found in the 4000.1 HUD Handbook, which really is, you can think of it as using your savings as a supplement to the difference in income. So these are calculations based on the reserves you have left over and beyond what you need to close. So refer to the 4000 Handbook for those cases for borrowers returning to work after the first payment due date. Hourly wages, you can find those on your job aid on page 6. Take a look at the details for your borrower, and do their hours vary if they're paid hourly. For employees whose hours do not vary, the lenders must consider the borrower's current hourly rate to calculate the effective income. So if your hours do not vary, use the current rate. And there's one of those cases where the guidelines use the word must. For employees who are paid hourly and whose hours vary, the lender must average the income over the previous 2 years. There's another one of those cases where the guidelines use the word must, doing that average over the last 2 years. If you can document an increase, the most recent 12-month average may be used. So look very carefully at your borrower's income documentation if they're paid hourly to figure out which calculation needs to be used. Overtime and bonus, that's still on page 6 of your job aid. Look at the trends for the overtime and bonus income. If the overtime or bonus income from the current year decreases by 20% or more from the previous year, you must use the current year's income. Here's another one of those cases where the 4000.1 HUD Handbook states the math that's used for certain income types. Many types of income with minor nuances in qualifying include commission income, job changes, and borrowers who are self-employed. And you can find those on page 7 of your job aid. For the changes in commission income, everything is very much the same as what you found in the 4155 HUD handbook. You still have to use net commission earned, and you have to deduct out unreimbursed expenses, so that has not gone away. Really the big change is that commission received less than 1 year is not acceptable. FHA stands firm on that now. There's no flexibility. Commission received less than 1 year is not acceptable. Job changes, if you look at page 7 of your job aid, you're looking at your borrower's loan application and looking at their job history for the last 2 years. And if they've changed jobs more than 3 times in the previous 12-month period, or if they have changed lines of work, you must take additional steps to verify and document the stability of the income. So it just takes some additional legwork and additional documentation to really prove that because this borrower has changed lines of work or they've changed jobs more than 3 times in the last 12 months, the income is stable and should be used for qualifying. Self-employed borrowers, really the only change for self-employed borrowers is that you may not use education or training to meet the history requirements for self-employed borrowers. Sources of funds and assets. You can find those on page 8 of your job aid. A new term is showing up in the 4000.1 HUD handbook, and a new acronym, MRI, which stands for your minimum required investment. We're used to calling it minimum investment requirement, but now I've changed the words around a little bit, so now you'll see a 3.5% minimum required investment, for example, MRI. If you also look on screen, the second bullet point, there's a new term called adjusted value that appears as well. And the adjusted value for a purchase transaction would be the lesser of the sales price or the appraised value. So for this slide, we're talking about recently opened accounts and recent individual deposits. So looking at your borrower's assets, for recently opened accounts and recent individual deposits of more than 1% of the adjusted value, the lender must obtain documentation of the deposits, and you also have to verify that no debts were incurred to obtain part or all of the minimum required investment. So let's look back at this again. If we're doing a purchase transaction, let's say we have a sale price of $100,000 and an appraised value of $105,000. Your adjusted value would be the lesser of the sales price or the appraised value, which would be $100,000. 1% of $100,000 would be $1,000. Let's say that there's an individual deposit of $1,500. So an individual deposit exceeds 1% of the adjusted value. Therefore, you must obtain documentation of the deposit and make sure that no debts were incurred to obtain their minimum investment requirement. The definition of adjusted value differs for a refinance. In fact, there's differences for the definition for how long the borrower has owned the property in the 4000.1 HUD handbook. There are requirements for the adjusted value if the property was acquired by the borrower within 12 months of the case number assignment date, and other different line item definitions. So refer to the 4000.1 HUD handbook for your full definition of adjusted value if you're doing a refinance transaction. Earnest money, still on page 8 of your job aid. The requirement has changed to state that earnest money deposit over 1% of the sales price must be verified. In the past, that was at a 2% calculation, so now FHA has become more strict and making that earnest money over 1% of the sale price must be verified. Generally, you're finding that you're documenting the earnest money deposit anyway, regardless of the amount, in order to verify the funds were not borrowed. So this just might be one of those cases where there may have been discussions in the past with parties in operations, and this makes things much more clear. Source of funds, you're going to find that with this new 4000 guide, really it's much more strict than a lot of your conventional conforming loans call for, particularly with retirement funds. Over on page 8 of your job aid, if any portion of the asset is required for funds to close, evidence of liquidation is required. And in other cases, Sale of real property. This means borrowers selling a house and using those funds in order to purchase the new house, which have an FHA loan. By doing that, you have to have verification of and documentation, which would include a HUD-1 settlement statement. You have to verify and document that the transaction was arm's length. That's a new aspect for the new 4000.1 HUD handbook than what we're used to doing before. You have to show that it was an arm's length transaction and the borrower is entitled to the net sale proceeds. One other thing over on page 8 of your job aid is, what if the borrower sells personal property like artwork? If that's the case, you must obtain satisfactory estimate of the value of the item, a copy of the bill of sale, and evidence of receipt along with deposit of the proceeds. There are certain cases where you run the information through FHA's total scorecard, you receive approve, accept, that's great, but you realize that something wasn't read properly from the credit report into total scorecard, so that is basically saying that that approve, accept recommendation is invalid. So in the event the mortgage file contains information or documentation that cannot be entered into or evaluated by total scorecard, that might require us to downgrade it and consider it like a manual underwrite. And of course, there are manual underwriting guidelines in the new 4000.1 HUD handbook. Or if there's additional information not considered by the AUS recommendation that affects the overall insurability of the mortgage. Let's say, for instance, you find out that the income is not stable. The automated underwriting system doesn't analyze that, it just looks at the income figure. And so if this could be a potential insuring issue, that would be requiring us to downgrade and do a manual underwrite. Other aspects, and these are all found for you on page 9 of your job aid. The borrower has $1,000 or more collectively in disputed derogatory credit accounts, or the date of the borrower's bankruptcy discharge as reflected on the bankruptcy documents is within 2 years from the date of the case number assignment. If you recall, the bankruptcy guidelines call for at least 2 years. So if your bankruptcy documentation is within 2 years, that approve accept is null and void, and now it has to be manually underwritten. Case number assignment date is within 3 years of the date of the transfer of title through a pre-foreclosure or short sale. That would require a downgrade to a refer and consider that like a manual underwrite. The case number assignment date is within 3 years of the date of transfer of title through a foreclosure sale. That would require a downgrade to a manual underwrite. The case number assignment date is within 3 years of the date of transfer of title through a deed in lieu of foreclosure. That would also require us to downgrade. Now, you also have to take a look at your mortgage payment history. And the 4000.1 HUD handbook takes a look at, here are the requirements for a purchase or a no cash out, which would also be called a rate and term refinance. So you're going to find if any of these things occur on screen, that would require the approve accept to be null and void, and they would have to be manually underwritten. So here are those requirements. Remember, these are for a purchase or a no cash out, are also known as a rate and term refinance. 3 or more late payments greater than 30 days, or 1 or more late payments of 60 days plus 1 or more 30-day late, or 1 payment greater than 90 days late. Typically, your automated underwriting system will pick up on that type of thing and issue the refer, but if for some reason the total scorecard did not see those items for a purchase or a no cash out refinance, that would require us to do a manual underwrite. Now let's look at the guidelines for a cash out refinance. That's in the first bullet point at the top of the screen. If any mortgage trade line reflects any delinquency within 12 months of the case number assignment date and or there is a current delinquency, that would require the downgrade to a manual underwrite. So as you can see, the cash out refinance guidelines are much more strict than that of the purchase or no cash out refinance, which has some less strict requirements, but still keep those in mind in case it has to be looked at as a manual underwrite. Back to the screen, other aspects that would require a downgrade include the borrower has undisclosed mortgage debt not evaluated by the automated underwriting system, or business income shows a greater than 20% decline in effective income over the analysis period. Let's look at the changes for the appraisals, and that's where you can look at page 11 of your job aid. Several changes in new construction definitions and documents are occurring. You can find the details for the new construction definitions over on page 11 of your job aid. For example, here is the definition for new construction: 100% complete, never previously occupied. You also have to take a note of FHA's definition of existing construction. This is a property that has been 100% complete for over 1 year or has been completed for less than 1 year and was previously occupied. So we've got new definitions of what new construction is versus existing construction. As far as procedural changes, that primarily refers to the new construction exhibit. And that means it is now the lender's responsibility to ensure the appraiser has been provided with certain exhibits for new construction. And you can find those over on page 12 of your workbook. These include the 92541, the HUD 92541 form, which is called the builder's certification. That has to be fully executed, signed, and dated not more than 30 days prior to the date the appraisal was ordered. As a lender, it's their responsibility to make sure the appraiser's been given that. And then depending on properties, if they're 90% completed or less, or if they're greater than 90%, but less than 100% completed, there are additional requirements. I'm going to leave those with you to take a look at on the job aid. The last thing with the screen is in cases where a borrower has switched lenders, the first lender must, at the borrower's request, transfer the appraisal to the second lender within 5 business days. So this is something that FHA didn't have in writing in the past, so it really wasn't very clear. But now it really places a timeline on transferring appraisals and making sure that the first lender completes that in the appropriate time frame to transfer the appraisal to the second lender. Lead-based paint, well, that's still a statutory requirement for your FHA loan, but there's just some additional responsibility that's been placed on the lender as well. Those are also on back on page 11 of your job aid. The seller is still required to disclose the known information, but the lender is responsible for ensuring several items are in place. We've given you the citation for it to take a look at to see what all the guidelines call for. It also includes purchase contract requirements and the role of the seller's agent. All of that has been outlined in the 4000.1 handbook for you. Photos, front and angle photos are required of the comparable. Hallway photos are required on 2 to 4 units. The appraiser must note evidence of methamphetamine or meth contamination. The appraiser must treat room additions and garage conversions as part of the gross living area of the dwelling, provided a few things are in place. And they also have to provide a 3-year prior sales history for the comparables. Now that last one I don't believe is too much of a change, but some individuals in the industry are identifying that that's a little bit different than what they're used to. So, but now it's clear and in writing in the 4000 handbook. For the roof, go ahead and turn to page 13 of your job aid. The appraiser must notify of any deficiency in a minimum property requirement or minimum property standard. That basically means FHA's requirements for a property that's safe and sound for our borrower to move into. The appraiser must notify the lender of a deficiency of a minimum property requirement or a minimum property standard if the roof covering does not prevent the entrance of moisture or provide reasonable future utility, durability, and economy of maintenance, and does not have a remaining physical life of at least 2 years. So roofs typically have proper ventilation and or insulation, and moisture should dissipate. Appraisers should note if this doesn't appear to be the case. Dual employment, you can go ahead and take a look at page 14 of your job aid. As a lender, that must require its employees to be its employees exclusively unless the lender has determined that the employee's other outside employment, which would include any self-employment, does not create a prohibited conflict of interest. Conflict of interest employees are prohibited from having multiple roles in a single FHA-insured transaction. For example, You're not going to be originating an FHA loan and then underwriting it. Okay? Employees are prohibited from having multiple sources of compensation, either directly or indirectly from a single FHA insured transaction. Underwriters, lenders have to make sure that the underwriters are not managed by and do not report to any individual who performs mortgage origination activities. So there needs to be a separation of duties. Lenders must ensure that its underwriters meet basic eligibility requirements and perform the underwriting function in a manner that's consistent with FHA guidelines. How the sales team will adjust? Sales will need to resync all of their FHA loans in the pipeline and review pending applications. Take a look at your pipeline and determine when was the case number ordered. Was it ordered before 9/14 of 2015? If that's the case, that's where you have to comply with the 4155.1 and .2 HUD handbooks. Or if it's ordered on or after 9/14, that's where you would use the 4000.1 guidelines. Will the loan close within 90 days? If it's taking a long period of time to get your borrower to close, are you going to need to look at updating documentation? A few practices that help the borrower qualify are now eliminated. Think of those examples for student loans, where in the past you may have been able to exclude a payment from the DTI. Not anymore. You have to have a monthly payment for your student loans. And in those cases, for your installment loans with less than 10 months remaining, you may have been able to exclude those in the past. Not anymore. With the new 4000 guidelines, you have to include a monthly payment to qualify. So you're going to need to adjust your script or the words that you used to coach the borrower in the past and talk to them about the details on their credit report. Consistency is critical to stay in compliance with fair lending and the Equal Credit Opportunity Act. It is very important that we never lose sight of fair lending. That has not gone away with the 4000.1 HUD handbook. So it's very important to be consistent with your treatment of your borrowers. There is an opportunity to train your realtors on FHA, just as there was for the TILA-RESPA Integrated Disclosure Rule. Compensation, that's still on page 14 of your job aid. All compensation earned from origination, underwriting, and or servicing of FHA insured loans must be reported to the IRS on a W-2. Employees who perform underwriting and loan servicing activities, however, may not receive commissions. It is okay to pay a bonus for underwriters and those who are paid salary, but you cannot, for an underwriter or loan servicing, if you perform loan servicing activities, you may not receive commissions. Income earned on non-FHA loans can be reported to the IRS on a 1099. During normal duty hours, employees who are involved with FHA transactions may only conduct the business of the mortgagee or the lender. So here are some key factors to think about and things to talk about in your staff meetings before the 9/14 effective date. Can your system correctly identify the case number every time? Is it very clear if you were, what date the case number was ordered, so you know which guidelines to follow? Identify if there are any system workaround steps that are needed. You want to make sure that you're aware of that, and anybody that's involved with FHA loans are aware of those, so you've got the appropriate details populating your documents for the 4000.1 handbook guidelines. Train all your team members on the new rules and teach your underwriters how to apply the rules. It's very important that we're all going forward and understand where to find the new rules, what they are, and how we can apply them. It impacts everybody in operations. The underwriters have the ability to adjust. There have been many cases where we've had significant guideline changes, so we have to think of it as out with the old and in with the new, just like everybody has done in the past. How mistakes in guidelines will be managed, well, that will be something that the individuals in management will come up with a process to keep that straight and how they will manage it. You'll find that quality control and quality assurance measures are going to be used to identify that the FHA changes have taken hold. You might see a combination of QA and QC results. There will be compliance ownership involved. They act as a second set of eyes, which is always a good thing to make sure everything is being followed properly. And you might see some process changes for some compliance checks conducted immediately after origination. Perhaps they might be done prior to underwriting and then prior to closing. So it's important to get this right. The FHA program still has many advantages over conventional loans. I don't want you to lose sight of that. The FHA is still a great program, it's flourishing, and it has many benefits for many of your borrowers. Many of the changes will protect FHA's risk as well as the lender's risk. You've probably been reasoning your way through that as we've been going through the guidelines, that it really is to help protect risk. Lenders will still continue to monitor performance of FHA loans and determine credit overlay changes once loan performance data starts coming in. The Why I Love FHA list lives on. We have a list that we always use in any of our trainings that talk about why we love FHA. We have to amend it a little bit based upon some of these guidelines, but it's still a significant list, and we are very much fans of the FHA loan program, and that still lives on. Thank you all very much for your time. I hope you learned a lot and are very excited about the 4000.1 HUD Handbook, and I hope to speak with you again in the future.